MNP again. So we're going to start the webinar. I'd like to start off by saying thank you for taking time out of your day to attend this webinar with us. We're really happy to have you for our tax debt webinar. So the way the webinar is going to work, if you guys have any questions, feel free to submit them through the chat box. The chat box is anonymous, so no one else will see your questions except for us. We will try to get through as many questions today as possible. If we don't get to your question, we will actually follow with you personally at the end of the webinar. We had a question already submitted that will you guys get a professional development credit for attending this webinar? And that depends on your association. If your association allows, we can provide you proof of attendance and then you can receive a credit. But check with your association first and let us know, and we'd be happy to provide you anything on our part. All right, so I think that covers everything on my end. So I'll start with our presenters. Today we have Donna Carson. She's a licensed insolvency trustee with MNP. For 25 years, Donna has been helping people with small businesses who are experiencing financial difficulties, including helping them to deal with their creditors and their budgeting. Prior to that, she worked in public accounting and in the oil field. We also have on the line Lance Bick. Lance is a partner with MNP's Taxation Services Group in Red Deer. Having completed CICA in-depth tax program in 2010, Lance works closely with clients to deliver effective tax strategies for tax minimization in corporate structuring, acquisitions, and diversities, as well as domestic compliance and assisting with audits and appeals of tax assessments. All right, well, enough with me. I'm going to hand it over to our presenters, and the first one to present is Donna.
Thanks, Savannah, and thank you, everybody, for attending. So what we're going to talk about today is just some options if you haven't filed your taxes or returns for several years. We'll talk about some different options there. We're going to talk about the different types of CRA debts. We sometimes get questions from people as to what the different accounts are. We'll talk about some informal options to deal with tax debt and also some formal options to deal with that debt. And then we'll wrap it up just by talking about what things you get to keep if your creditors are seizing or if you are going to file something to deal with your debt, and then have some time at the end for any questions that we can answer for you. So just so you know who the heck it is that's presenting to you today, MNP, formerly we were known as Myers North Penny, is a full-service accounting and advisory firm. We started back in 1958 in Brandon, Manitoba, and currently there's over 3,700 team members with the firm. We're the 5th largest firm in the country, behind the Big Four. And we do have different arms, I guess, if you will, to MNP. And so Lance is a partner with MNP LLP, which includes our specialty tax services and the options that he's going to talk about today. And I'm a partner with MNP Ltd, which is our insolvency and our corporate recovery side of the practice. And currently we've got 71 licensed insolvency trustees. We go coast to coast now, and over 150 different offices to help people and businesses that might be struggling with debt, including CRA. And so we are national if anyone does need to contact us to talk about the different options. So what are the different kinds of debt? Sometimes we'll have people call us with their different statements and the different account numbers, and they're not familiar with what they are. So your personal income tax or your social insurance number will show up on the statement as an RI debt. GST, HST debt will show up with an RT number. Source deductions is an RP account number. Corporate income taxes is an RC account number. And then other types of debt. Directors of a corporation, for anyone who may have a business, if it's incorporated, the directors of that company can be personally liable for the RT and the RP debt if CRA assesses you personally for them. And then there's also what is called a Section 160 assessment, and I'm going to talk about what that is in a minute. It's a section of the Income Tax Act And basically that is where the CRA debt gets assessed to your personal tax account for certain reasons that we'll talk about here in a minute. So what is Section 160? So it is a section, in this case, of the Income Tax Act, and then there are, I believe, related provisions as well under the Excise Tax Act. And kind of in a nutshell, what it deals with is transferring property to a non-arm's length party. So that could be a relative, it could be your spouse, or it could be the owner of the business. And so you're transferring away property from the person or the company to someone else, and it's at a time that you have debt owing to CRA. So basically, if you were going to transfer away something, you are to be paying your tax debt first before you transfer that property away. And what CRA can assess people for is for the lesser of the value of the property that was transferred or the amount of the debt is owing. So just to give you a quick simple example, if a husband has a $5,000 vehicle and he's got $10,000 of debt owing to CRA, if he transfers that $5,000 vehicle to his spouse, let's say, CRA could raise an assessment against the spouse for the $5,000, the value of that property that perhaps should have been there to pay the debt that was owed. Another example would be if a corporation transfers property to, let's say, the owner of the corporation at a time that the corporate tax debt is owed. That would be a situation where CRA could raise an assessment against the owner. And property also, versus just physical assets like a truck, let's say, it also does include declaring dividends. Distributing the profits from a company to its shareholders is sometimes done by way of dividends, and dividends is a distribution of property. And so what we commonly see is if the shareholder has received a T5, so for the money they have taken out of the company, they receive a T5 slip for their earnings that year, which can be better tax planning than a T4 wage. But if there is debt owing to CRA at that point in time, CRA could go after that shareholder for either the lesser of the dividend or the lesser of the tax debt that was owed. And that one we do more regularly see, I guess, is when shareholders are paid dividends from the company. So I'm also going to talk next about some of the collection actions that CRA can take. And when I say without notice to you, it's probably after statements have been sent and things like that. But if they're going to garnish your paycheck, garnish bank accounts, seize assets, they can then do that without further notice to you. They can also issue what's called a requirement to pay. A requirement to pay is it's the name of the form essentially, and that is the form they would issue to garnish your bank account, for example, or they could also issue that if you're self-employed, they could issue that to your accounts receivable in order to try to garnish that asset. They can also file what's called a writ at Personal Property Registry. And so if they do have a judgment against you for debt that's owing, they could file a writ at Personal Property Registry, or they could also file that writ on title to your house. And what it does is it kind of protects them, I guess, so that you couldn't then sell that asset, or it also gives them security interest, if you will, in your house. It gives them different priority in the distribution of assets than would be there if they didn't have the writ on the house. So having said all that, and that there are different collection measures that CRA can take, perhaps you have some valid grounds to appeal that tax debt. And I'm going to let Lance talk a bit about appeals and a couple of other programs.
All right, thanks, Donna. We don't have any slides prepared on objections or appeals. It's a very extensive process, and it can be lengthy, it can be costly. It is still a valid option in a lot of cases. Sometimes you filed your return correctly and it's been assessed incorrectly, sometimes on simple matters, sometimes maybe a more complicated filing position you've taken on something. Sometimes you've been assessed incorrectly because of poor bookkeeping perhaps, and an audit went wrong, but the assessment against you can be substantiated with cleaned up bookkeeping. Sometimes there's a personality conflict between a taxpayer and an auditor, and the auditor kind of gets a gripe, I guess I'll say, and isn't really interested in working with the taxpayer. A lot of different situations arise for audits and appeals, and the process that it goes through, again, could involve an entire another webinar, so I'm not going to stretch that one out. But it can be a valid option, and if you think that you're in a situation where you've been assessed incorrectly, then if we're successful with an objection or appeal, it can be a very valid, a very worthwhile endeavor. So feel free to contact one of our offices if that's the case. What I am going to talk about in a little more depth is the Voluntary Disclosure Program. The Voluntary Disclosure Program is effectively a second chance to self-assess income that hasn't been reported prior. So this could be unfiled tax returns, it could be undeclared income, such as rebates or shareholder benefits. Sometimes you weren't aware of it at the time. It's not necessarily that it was something that was malintentioned. I've seen people fail to report foreign income because it had been taxed in another jurisdiction, like a foreign pension. It may not be a significant deal, but it had to be reported as part of your worldwide income in Canada. The VDP, the Voluntary Disclosure Program, allows you to pay the taxes and the interest owed, which even in some cases the interest can be reduced, but avoid the associated penalties. You can report income from up to the last 10 years. You cannot qualify for VDP further back than 10 years, but for it to be allowed, the taxpayer has to fully disclose everything, even if it goes beyond 10 years. So if you're 15 years behind in your filing and you want to catch up, you're not going to be able to qualify the prior 15 years, but you could qualify those 10 years, which can be significant. Repeated failure to file, for example, on its own, comes with a 10% federal penalty of the taxes owed and a, usually equally 10% provincial penalty. So the penalties can really add up, and really this program can really contribute to lowering the bottom line you owe the CRA. The VDP can be utilized if there's 4 criteria met. The first is that they cannot have undertaken any compliance action or request before you file your request for VDP. So if you've already received a demand to file on a year that's outstanding, or they've already started an audit process against you, the VDP isn't relevant anymore. A penalty has to apply to the income or filings to report. If you have a year that you don't owe any taxes, VDP is unnecessary because there is no penalty or interest assessed against it. It doesn't mean they may not have a nominal assessment against you already or something along those lines, but notional assessment. But in actuality, if you don't owe taxes, there's no penalty applied to a tax return, for example. The information has to be at least 1 year overdue, and I've seen people get to a point where they've decided that they're going to wait. For example, I'm going to pick on the Form T1135, foreign reporting for assets over 100,000. It's not a taxable return, but I'm going to pick on that one quite a bit here for the next little bit for examples. I've seen people not realize they had to file it, realize that they got into a situation where they had to file it within a year of their filing deadline for it, and then they get to that, well, what do we do now? Do we accept the $2,500 penalty that can be associated with it, or do we set out the 1 year? There are potential downside risks to that, because if CRA realizes it's outstanding and they request it, you could be on the hook. So it's a strategy that you should measure both sides of before you undertake. The last part of it is that the information, again, as per prior slides, needs to be complete. You can't file the years you want to admit to. Everything's got to be put forward to catch everything up. So the VDP can apply to a number of different areas. Unreported income is one, as we talked about. Ineligible expenses, somebody claiming a home office when it doesn't qualify, or perhaps overzealous with their expenses. We've had a couple times where a prior advisor was not as reasonable in claiming the expenses as they should have been, and some of his clients were coming under audit, and some of the other clients decided to, upon realizing what the situation was, come forward and report all the ineligible expenses before CRA looked at them. They may never have, but when they realized they were offside, they decided, let's just get onside. Again, unfiled tax returns. GST, oftentimes GST on property sales people thought was exempt and maybe wasn't. That can happen quite easily. Payroll remittances where employee benefits were perhaps missed or something along those lines, or failure to disclose altogether. Again, that T1135 form I was talking about can have up to a $2,500 penalty. So filing that under VDP when there's actually no tax associated with it can be very beneficial. VDP does not always apply, and it cannot apply to post-assessment requests for relief from penalties or interest. So if you've already been assessed, you can't file VDP. If you got, say, one of the notional assessments where they said, well, we don't know how much you made that year, but we're going to assess you this much income tax, that's really supposed to be an incentive to get you to file, but you can't file a VDP at that point in time. However, we can discuss here shortly perhaps using a fairness request in those situations. Again, returns with no taxes owing because there would be no penalties associated with them. Elections, there are certain elections available throughout the Income Tax Act, and most of them either have deadlines or have their own provisions for late filing those. Bankruptcy returns, advanced pricing arrangements for cross-border, or rollover provisions such as transferring farming or fishing property down to children. None of those situations can you actually apply a VDP towards. So another option outside of the VDP would be the taxpayer relief or the fairness provisions. These provisions allow CRA to give a taxpayer relief when liabilities arise not at the fault of the taxpayer. These are usually extraordinary circumstances. Something happens, perhaps death, illness, disaster, something out of the normal course that you were just unable to be compliant with your taxes for the period at question. Actions of the CRA, such as delays in assessments, audits, some of those things happen. They get backed up just like everybody else does at work sometimes, and stuff sits on the shelf, or unfortunately even I've seen paperwork get lost in that situation, and when that happens, it's not reasonable that the taxpayer should foot additional interest or penalties when it wasn't their fault. Or inability to pay or financial hardship. Now, that one's a really tough one to qualify for. I've never seen it granted for like GST, for example, or payroll deductions, because you were given that money, you had that money in your hands in trust for the government in their opinion, so that won't work. There are certain cases where I've seen it work for tax, and I'll talk about those in a moment. Now, the fairness request can actually be used to reduce or cancel penalties or interest. It can also authorize a refund when it's late filed if you have filed a return past certain periods of certain credits or refunds even altogether that you can't qualify for. If you would qualify for fairness, they might allow that refund anyway. Extension of filing deadlines for certain elections, that's separate from the VDP obviously, and authorized reassessments outside of the normal period where this would result in a reduction to taxes or other taxable payable or other taxes payable. For the fairness to qualify, CRA, this is really fairness isn't something that they have to do. It's really up to the officer that you get a hold of who reviews the filing request. this is really discretionary on the behalf of CRA. So they're going to look at a number of things. They're going to look at how compliant have you been historically? Have you filed on time? Have you paid your taxes on time? Are you generally not in the situation that you'd be asking for a favor like this? Was the taxpayer aware of the balances in interest and not acting on them? Has reasonable care and effort been used when self-assessing? And was there timely remediation? So I had one, I'm going to start with one that didn't go well. There was a child who the family had a number of kids, but their youngest child developed a impairment, and they missed filing for a couple of years, and they had come across some significant tax balances, and they had, because of helping him with the treatments and whatever they had to go through to manage the family, they were about 7 years back on total compliance on this one. And the fairness request for the relief of interest and penalties was not granted because they really hadn't been addressing the situation at all. And the CRA felt that 7 years of stretching this out was not timely enough for it. So I don't recall off the cuff how the VDP portion went, but I know that the fairness was waived in that one. I've seen a one-off situation with it was a company that had a very successful year, I think in 2013, and they had issued a lot of bonuses to their staff over Christmas, and because of that, they actually moved themselves into an accelerated remitter situation for payroll deductions, and they had filed on time for their normal deadline, which was January 15th, the month following, but not realized that they had crossed into this advanced remitter, and it was a one-time situation. And they got penalized for 10% of the remittances because it was late filed. We filed a fairness request. Again, they had been historically very compliant. They had complied at the time to what the deadline they thought was. They took immediate action to remediate the situation. They actually paid the $7,500 before we filed and then requested the funds back, and they were actually granted fairness in that light. We've had a couple issues with senior citizens, health issues, unfortunate, timing of passing or something along those lines. And in those situations, we've actually had some luck with, getting the interest waived. And this probably ties a little more back to what Donna will talk about, but negotiating, these guys really were in a financially hard situation, and they weren't ignoring the debt. It's just they weren't able to pay everything up timely enough that the interest was really compounding on them in a bad way. And then I had one in my own personal family a while ago. My mother-in-law a few years ago passed away quite suddenly, and it left the family distraught as it does. But my father-in-law had opened up a new business that year, a new corporation. And with the passing and dealing with all the issues that come there about family, emotional, he did not complete on time his payroll remittances, his GST filings, his T4 and T5s, his corporate tax filings, or his personal tax filings. And it took a few months to get everything sorted out in his own life to kind of get back to focusing and catching the bookkeeping up and everything like that. But within the first year, we were kind of back on focus, and he got everything caught up, and we filed for him under fairness request, and CRA actually waived all the interest and penalties associated with all of them. He still had to pay the taxes and the remittances and the GST, but it was still a very good outcome for that one. So again, when situations get out of hand and not at the fault of the taxpayer, and there is something outstanding, this can be an effective way to help alleviate the burdens, particularly the interest and penalties, because through the variety of penalties and interest, this can add up quite quickly. Within a year or two, you could be looking at an increase of 20% of the debt for no real cause. So if your situation allows for it, definitely the fairness provisions or even the VDP, as I discussed before, can be ways to help manage the debt before it's out of hand. But I guess once it gets to that point, I think Donna's about to talk about some of the options when that final bill is a little high to manage still.
Okay, thanks, Lance. So now I'm going to go into talking about some options as to how to deal with the CRA or other debt as well if the other informal options or the options Lance talked about haven't resolved at all. So the first ones I'll talk about are going to be some of the informal options. So as with any creditor, ensure that you are keeping CRA updated as to what's going on. If they can't reach you, can't find you, or aren't updated if you can't meet whatever agreement you have with them, again, as with any creditor, they're probably a little bit more apt to get anxious to start some collection measures. So keep them updated if something's happening so that they know what's going on. One option might also be to give them a comfort level. Maybe you could offer to give them security against some of your assets. So, for example, you're going to make payment arrangements to them, but maybe in the meantime they could have security on my house. Or maybe I could give them an assignment of some of my accounts receivable while they let me continue to realize on the rest of them. Those could be a couple of ways to try to work out an informal arrangement with them. The only caution that I would add there is to ensure you're seeking advice and just to be careful that you're not creating any preferences. If there are assets available or money available for distribution, for the most part, all your creditors are entitled to that. Now, CRA and some creditors do have certain priority, but not always. And so I just caution you to be careful about giving preferential treatment and to talk to a professional first before you do that. Family help. So perhaps some people have access to money from family or a friend to be able to deal with their creditors, and I would just caution you to make sure you put it in writing so that there's no questions later on as to how much was borrowed and the tentative repayment plan, that kind of thing. Consolidating is an option, and some banks will look at consolidating all your debt when it includes CRA. Not all institutions, but some will. And then there are also informal consolidation or debt pooling programs that are out there to consolidate all of your debts into one repayment plan. I would make sure that you're ensuring that your plan is going to deal with all of your debt. You want to be careful about just dealing with one creditor if I maybe have other ones that are out there. And also to make sure that your plan is making the payment from after-tax dollars. So, for example, if you are self-employed and I have past debt, but being self-employed, I'm obviously going to have debt going forward as well. So ensure that whatever plan I'm putting together is with after-tax dollars. I'm paying my current installments, and from what is remaining, that is what I'm using to pay my past tax debt. And then if the informal options aren't working, aren't sufficient, or aren't going to deal with the whole situation, then there are some more formal options that are out there. One of them is known as the Orderly Payment of Debt Program, or OPD. It is a formal program. It is actually part of the Bankruptcy and Insolvency Act, or the BIA we call it. It is part of that legislation, as is the Farm Debt Mediation Act or CCAA that you hear in the news sometimes. They're all part of that federal legislation known as the Bankruptcy and Insolvency Act. And it's a program that's available still in 3 provinces. Alberta, Nova Scotia, and PEI still have the OPD program. And the intent of the program is a way for people to be able to pay their debt in full, and it can include CRA debt. So it's like a debt consolidation, except that you're not going to the bank to borrow money to do it. It's just taking the debt that you have and figuring out a way to pay it back from what I have right now. It's operated by nonprofit agencies. It's a 5% interest rate. There's no reduction in the amount of the principal that you owe, but it can drop what the interest rate is that you maybe have been paying to CRA or any of your other creditors. So the intent of the program is a way for people who can afford to pay my debts in full, and I just need a structured, formal way to do it. Then there's also a formal option known as a proposal. Again, this is a program that is legislated under the BIA. It is a program intended to allow people or companies to repay their debt, and it can be, well, anywhere from 10 cents on the dollar to 100 cents on the dollar. It just all depends on what the circumstances are. Sometimes, yes, it is payment in full, but what it does, even in those cases, is it stops the interest clock. There is no interest on this program going forward, and it is generally done over a period of time, up to 5 years. But there are ways to do it over longer periods of time if needed. And so it takes the debt that you have. We look at what your assets are. We look at what your budget looks like right now and put together a plan called a proposal to offer your creditors a structured settlement of some kind. Proposals are administered in Canada only by licensed insolvency trustees like MNP. And I guess with respect to CRA, one of the other benefits of it is that it does return you back to good standing with CRA moving forward. Whenever we do proposals to CRA, one of their understandably mandatory terms that they require is that the person will remain compliant with their tax or GST filing and payments going forward, which kind of ties in with what I said earlier in that we want to make sure, however we're dealing with your past debt, is done with after-tax dollars. Just a couple of examples. We have one more recent example that actually tied in with the VDP program that Lance was talking about. And so an individual had fallen several years behind on filing her personal tax returns. She knew that she was going to owe money, and she knew that it was going to be more debt than what she was going to be able to manage. And so what was done is that Lance filed the returns under VDP for her, and then kind of the next day, so to speak, we filed a proposal to offer CRA a settlement to deal with that debt. Now, in her particular case, as with any proposal, they're going to look at what your story is, if you will. So her story is that she was now a senior. She had some medical situation, and not other than her pension, she had no other outside source of income coming in. And so I think it was actually 10 or 15 cents on the dollar proposal that we did to CRA in that example. Now, not all of them are definitely 10 to 15 cents on the dollar. Again, it depends on your story, your budget, your assets. Some of them are 100 cents on the dollar. I have good income, lots of assets, and I've just fallen behind on paying, but the interest clock is killing me and I just can't catch up. And so we have done some proposals that are even with after-tax dollars. I'll pay my CRA debt 100 cents on the dollar, but it just stops the interest clock going forward while I deal with the past. We've also done some proposals and bankruptcies as well that I'll talk about in a minute to deal with some of the tax schemes or scams that you see out there. So, for example, a person had hired a company to file and or amend some tax returns for them. And unbeknownst to him, what they had done was claim some business losses that it seems weren't real, true business losses. So when you have a business loss, you can carry those losses back. And so what the company had done was carried back those losses and were requesting a refund of taxes that had been paid in prior years. And in some cases, the people did receive the tax refunds, and in other cases, they haven't yet. CRA started to investigate and caught it, if you will, and disallowed the losses. But there was penalties surrounding that. And so we have filed proposals to deal with the tax or the penalties and interest arising from some of the tax scams that are out there. The other formal option that I'll talk a bit about is the bankruptcy. Again, it is certain sections of the BIA, the federal legislation. It will stop the CRA collections with certain exceptions. So if the requirement to pay has already been issued, if CRA has already sent that piece of paper to one of your accounts receivables, those probably can't be stopped. Or if CRA has put a writ on title to your house, depending on the amount of equity that is in your house, it may change how we deal with CRA in your bankruptcy. And so, as with any situation, there's always benefits of seeking advice early because how we deal with the debt may change if these requirements have been issued or if the writ is on title to your house already. Filing a bankruptcy and filing the proposal that I just talked about does provide you with immediate protection. So it puts a stay of proceedings, we call it. It puts that into place. So your creditors are stopped while we go through the process of administering the bankruptcy or filing the proposal. So it gives you immediate protection from further collections. It allows you a fresh start. The intent of a bankruptcy is that I've fallen behind to the point that I'm not able to manage the debt anymore, and the other options that we just went over aren't going to be the right ones or don't work for me, and so a bankruptcy does allow you a fresh start. We do quite often get asked, can you include tax debt in a bankruptcy? And the answer to that is yes, you can include tax debt in a bankruptcy. There are special rules. If you owe over $200,000 of tax or payroll remittance debt, there are different rules for it, but they are included. When you file a bankruptcy, we do go over a list, and you have to declare what all of your assets are as of that date. And we look at what they are, and we look at the value of them, and you don't lose everything. The intent of the bankruptcy, like I said earlier, is to allow you a fresh start, and so you don't lose all of your assets, and I'm going to talk next about what are those assets that I do get to keep. And as with the proposal option that I just talked about, bankruptcies are administered in Canada only by a licensed insolvency trustee such as M&P. So what are the exemptions? So exemptions are assets that you get to keep if your creditors are starting to seize, or if you are filing a bankruptcy, or when we're looking at a proposal. They're the things that I get to keep. There are federal exemptions that are the same right across the country, and then each province also has its own exemptions. Exemptions are foregone, if you will, if you give that asset as security to a loan. So, for example, if you are entitled in Alberta, for example, to keep a $5,000 vehicle, but if you have given that vehicle as security to a bank for a loan that you borrowed from them, you are foregoing your right to that exempt vehicle, and the security on it by the bank trumps your exemption, if you will. And CRA registering their writ or their judgment on title to your house or at personal property registry to vehicles and things like that is a deemed security agreement. So if CRA gets a writ registered on title to a house, it's kind of the same as having a mortgage on the house. And we have to deal with that mortgage when we do a proposal or do a bankruptcy, or if you're dealing with the debt on your own and CRA has a writ on title to your house, it does give them powers to try to force a sale of your house. We do have a detailed list of what all the exemptions are. It's on our website, so mnpdebt.ca. If you go on the Resources tab under the Debt Relief FAQs, you'll see a list there of what do I get to keep, and we have it broken down province by province, depending on where you live. So just to give you some examples, in Alberta, you're entitled to keep, $4,000 of basic household items, $5,000 equity in a vehicle, $40,000 equity in a principal residence, RSPs and RESPs. Those are some examples of what you do get to keep if your creditors are seizing or in a bankruptcy in Alberta. So if any of this has applied to you, if you have fallen behind on filing my taxes, my GST for several years, what you probably want to do is contact someone in our specialty tax group, such as Lance, and we'll give you the contact information in a minute, so he can discuss the VDP or the fairness application or the appeals as well that he talked about. And we do have specialty tax groups from BC to Montreal or to Quebec. And then with respect to dealing with the debt options, you may want to talk to someone in our insolvency group. We'll sit down with you. There's no obligation. There's no charge for that initial meeting, just to talk in detail about those options, like the bankruptcy, the proposal, and those types of things as to how they would work for you in your specific instance. And ensure that you know all your options that are out there as you're making a decision as to what to do, and the big picture plan. As I mentioned earlier, dealing with one creditor, if I'm not dealing with all of them, might be a short-term fix, and so we want to ensure that you're trying to deal with everybody in the bigger picture as you deal with your creditors, including CRA. So we're going to now just answer any questions that anybody might have. As Savannah mentioned, you can just post your question on our website, and while we do that, I'll leave the page up here that has our contact information on it. So we do obviously have our direct lines, our email addresses. MNP Debt and MNP both have web pages, Facebook pages, with a lot of good information, and then we do have our Twitter and our LinkedIn accounts as well.
Okay, great. Thanks so much, Donna. So we got a question asking if this information, our PowerPoint, will be made available after the webinar, and yes, it will be. We can send you guys a PDF version if you would like, along with the webinar recording. And just a friendly reminder for those who joined late or didn't catch the very beginning, we had someone ask if this webinar would count for a credit for professional development, and it might, but just check with your association, see what their rules are, and if you need proof of attendance from us, we can provide that for you. It looks like any other questions, we can follow up with you personally. On behalf of MNP, thank you so much for attending today. And please remember, guys, anyone who attends today, you get a free 1-hour consultation with one of our trustees. And Lance and Donna will be following up with you guys. Thank you so much, everyone. You have a great day.
Thank you.